Ever notice how in the stock market, the hot stocks just seem to keep getting hotter, and the ones struggling tend to stay down?
Yeah, it happens all the time.
It's this thing called momentum, and if you're like me, it sometimes feels like a little wrinkle in the idea that markets are always perfectly rational.
Absolutely. For a long time, when we talked about why momentum exists, the conversation really centered on investor behavior. Things like people being, a bit slow to react to new info or maybe getting a little too confident when their picks do well.
Uh-huh. The behavioral explanations.
Right. But what if there's a whole other side to this story? What if it's not just about how we're thinking as investors?
Well, get ready, because in this deep dive, we're cracking open a really fascinating piece of research that looks at momentum through a completely different lens.
A new angle.
Yeah, we're talking neoclassical economics, the sort of fundamental drivers of what companies actually do. Think less about investor psychology and more about the actual business decisions that firms make.
It's exactly. Our goal today is to explore how these basic economic principles that guide companies, particularly their choices about investment, might actually be a really important underlying reason why we see this momentum effect.
So we're digging into a study titled A Neoclassical Interpretation of Momentum.
That's the one. And by the end, you'll hopefully have a fresh and maybe even surprising perspective on why momentum happens. Consider this your fast track to a much deeper understanding of this market puzzle.
Okay, so the backbone of this research is a pretty intuitive idea, actually. What you can expect to get back from a stock is tied to what the company expects to gain the benefits versus what it costs them when they decide to invest in their business.
Makes sense.
So companies that are on a roll, the winners, are likely looking at some pretty bright prospects, right? Expecting growth and healthy profits.
Right.
And this neoclassical view suggests that those strong future prospects could be why their stocks keep performing well. It's almost like the market is recognizing and, rewarding that potential.
Okay, but before we go further, let's just make sure we're all on the same page. When we talk about momentum, what exactly are we observing in the market? What are the key types?
Good point. The research highlights two main types of momentum that have been, well, pretty well documented. First up is price momentum.
Right.
This is the one most of us probably think of. Stocks that have had strong price gains recently, say over the last 6 months or so, tend to keep outperforming those that haven't. There's a really influential study from back in '93 by Jagadish and Titman that really put this phenomenon on the map.
Okay, price momentum, and the second type they discuss.
That's earnings momentum. This one's all about surprises in a company's reported profits.
Earning surprises.
Yeah. If a company announces earnings that are significantly better than what analysts were expecting, those stocks tend to deliver higher returns in the future. This was first highlighted in a key paper by Bernard and Thomas way back in 1989.
Got it. Price and earnings momentum. Now, as we mentioned earlier, the usual suspects for explaining these patterns have been rooted in how investors behave. What are some of those main behavioral finance explanations again?
Right, the traditional view. We're talking about things like conservatism, which is the idea that investors might be a bit slow, to fully absorb and act on new information.
They anchor too much on the past, maybe?
Kind of. Then there's overconfidence, where investors might overestimate their own skills or the accuracy of their knowledge.
Happens to the best of us.
And finally, the idea of slow information diffusion, which suggests that it just takes time for new information to fully make its way into stock prices across the whole market. Researchers like Barberis, Daniel, Hong, and Stein have done a lot of work exploring these angles.
Okay, but this research we're focusing on takes a different route. It essentially asks, wait a minute, maybe momentum isn't solely a result of investor quirks. What if we look at the actual companies and their fundamental economics? What's the core of their argument?
Their central argument is that momentum can be directly linked to the fundamental health of companies through their decisions about investment. Quite elegant, really.
How do they make that link?
They make an assumption called constant returns to scale. Think of it like a simple factory. If you double everything your workers, your machines, you'd expect to roughly double your output. It's a simplifying assumption, but useful.
Okay, and what does that assumption let them do?
Under this assumption, the paper argues that the return you see on a company's stock is fundamentally tied to the return that company expects to get on its investments, with a little boost or drag from how much debt they have their leverage.
Okay, let's dig into this investment return idea then. How do they actually define it in this context? What is it?
They define it as the expected benefit a company anticipates getting from making an investment in the next period, divided by the cost of making that investment right now in the current period. So it's a forward-looking calculation.
A ratio of future benefit to current cost.
Uh,
And how does this help us understand why some firms are winners and others are losers in the momentum game? What's the intuition?
Well, the basic idea is pretty straightforward. Companies that are performing well, those with recent stock price gains or positive earnings surprises, likely have stronger expectations for future growth and profitability.
Right. Makes sense. They're doing well. They expect to keep doing well.
Right. And these expectations directly influence the benefit side of that investment return calculation. So if a company anticipates a higher payoff from its investments, this model suggests that its stock should also offer a higher expected return compared to a company with less rosy prospects.
Ah, I see. So the high expected investment return translates into a high expected stock return.
It's like the market is pricing in that expected future success, driven by the company's own investment potential.
The paper even gets into the nitty-gritty of how a company decides how much to invest. Can you give us a simplified picture of that model?
Sure. Imagine a company trying to make its shareholders as happy as possible, maximize its value. They do this by deciding how much money to put into things like new equipment or R&D.
Okay.
But they have to weigh the potential for increased profits against factors like how much capital they already have, and, importantly, the costs associated with changing their investment levels. It's not always easy or cheap to quickly scale up or down, you see.
Right, there are frictions. And to put some structure around this, they use some standard tools from economics, right?
Exactly. They use something called a Cobb-Douglas production function to describe how a company's output, what it produces, depends on its inputs, especially its capital, like machinery and buildings.
Standard tool.
Yep. And they use a quadratic adjustment cost function. Think of it this way. If a company tries to invest just a little bit more, it's not a huge deal. But if it tries to invest a massive amount very quickly, the costs and disruptions really start to pile up. That's the essence of increasing adjustment costs. The cost per unit of investment goes up the faster you invest.
Okay, so those adjustment costs are key. Now, they actually derive a mathematical equation for this investment return. It sounds complicated, but what are the key pieces that go into that equation? Let's break it down.
Okay, so on the top part of the equation, the benefit side, the numerator, you've got a few key elements. First, there's the after-tax marginal product of capital.
Okay, what's that in plain English?
Imagine a company considering buying one more machine. This term represents the extra profit that machine is expected to generate after the company pays taxes on it.
Got it. Extra profit from the next dollar invested.
Right. Then there's the after-tax marginal reduction in those adjustment costs we just talked about. If you invest a bit now, it might make future adjustments slightly less costly. It smooths things out.
Ah, okay. A future cost saving.
Then there's also a tax benefit related to depreciation, the depreciation tax shield. Standard stuff. And finally, it includes the expected future value of having that extra bit of capital minus its depreciation. What's it worth down the line?
So future profit, future cost savings, tax shield, and future value. That's the benefit side. And what's on the bottom part of the equation, the cost side, the denominator.
That's the marginal cost of the investment itself right now. This includes the purchase price and also a component related to those adjustment costs again. The faster you invest today, the higher today's cost is.
Okay, so it's the full immediate cost.
Right. And the fundamental idea is that a company will invest up to the point where the expected future benefits, all discounted back to today, just equal the current marginal cost. That's the optimal investment level.
Standard economic reasoning. And how do they bridge the gap between this investment return and the actual return you see on a company's stock in the market? That seems like a crucial step.
It is. They bring in the concept of market leverage, which is basically how much debt a company uses relative to its equity.
Okay, debt matters.
It does. They also factor in the after-tax return on corporate bonds. Essentially, the return on a company's total investments can be thought of as a kind of weighted average of the return on its stock, what shareholders get, and the return on its debt, what bondholders get.
Ah, okay.
So if you know the expected investment return from their model and you know the return on bonds, you can then work out what the model implies for the expected stock return.
Yeah.
Sort of back it out.
Right, isolating the equity part.
Okay.
Now, to put their model to the test, they use a statistical technique called the generalized method of moments, or GMM. Sounds technical, but what's the basic idea?
Think of it as a sophisticated way of checking if the model's predictions based on those investment decisions line up with what we actually observe in the real-world stock return data? Does the model fit the facts?
And what were they primarily trying to estimate with this technique? What are the key knobs in their model?
They were mainly trying to get a handle on two key numbers. A, which represents the magnitude of those investment adjustment costs, how sensitive costs are to changes in investment.
How quickly those costs ramp up.
Exactly. And kappa, which is capital's share in the firm's production, basically, how much of the company's output is attributable to its capital investments versus, say, labor.
Okay, a 4 for adjustment cost, capital share.
Right.
So they've built this model, they've got this GMM technique, and they use real-world data. What did they discover when they looked at those momentum profits we talked about earlier, the winner minus loser returns? Did the model work?
Well, they analyzed both price momentum and earnings momentum by sorting stocks into 10 groups or deciles based on how they performed recently or how their earnings compared to expectations.
Standard momentum portfolios.
Right. And what they found was that their investment model did a surprisingly good job, actually, of predicting the average returns of these momentum-sorted portfolios.
Oh, really?
Yeah.
Oh, good.
For price momentum, the difference between what their model predicted and the actual average returns, the mean absolute error, was quite small. And for earnings momentum, it was even smaller. So small, in fact, that statistically, based on their over-identification tests, they couldn't even say their model was wrong in explaining those average earnings momentum returns.
Wow, that sounds pretty significant, especially for earnings momentum. What about those parameters they estimated, AS and co? Did the values they found make economic sense?
They did, yeah. The estimated share of capital was positive and within the range you'd expect between 0 and 1. It was maybe a bit lower than some estimates from broader economic studies, but the researchers point out that their approach, focusing on individual stock market data, is quite different, so it's understandable.
Okay, plausible.
And the adjustment cost parameter, AS, was also positive, which suggests that these costs of changing investment levels are indeed real and increase as you try to invest more rapidly. Again, the magnitude of their estimate was broadly consistent with findings from other different types of research, so the pieces seem to fit.
Okay, so the model fits the average returns well, and the parameters seem reasonable. But why does the model work? When they looked at the different parts of that levered investment return, what did they find was the main driver of the model's ability to explain momentum? What makes winners different from losers in the model?
Yeah, this is where it gets really interesting. They discovered that the expected growth rate of investment relative to the company's existing capital was the most crucial factor.
Investment to capital growth.
Exactly. Winning firms tended to have much higher expected growth in their investment compared to their existing capital than the losing firms did.
So winners are expected to ramp up investment more.
Right. And the sales to capital ratio that was expected in the future also played a significant role, with winners expected to generate more sales from their capital base. These factors really lined up with the intuition companies with strong momentum are those expected to invest more aggressively and be more productive with their assets in the future. Leverage also played a role, but these growth and profitability components were key.
Okay, that makes sense. Winners have better growth prospects driving their investment returns. But we know momentum doesn't last forever, right? It tends to fade and even reverse over longer time periods. Did their model capture that characteristic of momentum?
It did actually, to a notable extent. The real-world data show that the returns of those winner minus loser strategies for both price and earnings momentum are initially strong, but then they tend to decline and can even become negative after about a year or so.
The famous momentum crash or reversal?
Precisely. Their investment model also predicted this pattern of reversal. Now, maybe the reversal in the model sometimes took a little longer to fully play out compared to the actual market data, but the general U-shape, the eventual downturn, was definitely there in the model's predictions.
Interesting. And what was the engine behind that reversal in their model? Why did the momentum effect eventually peter out according to their framework?
The key driver in their model was the fact that the expected high growth in investment relative to capital didn't persist for very long. It was kind of short-lived.
The investment growth expectations fade.
Exactly. The difference in this expected investment growth between the winners and losers narrowed relatively quickly in the model. Interestingly, the difference in expected profitability, that sales to capital ratio between the winners and losers, was much more persistent in the model.
So profitability stays high, but the investment boom slows down.
That seems to be the story in the model. It's this fading investment growth advantage that seems to be a key part of why momentum doesn't last forever in their framework.
Okay, that's a neat explanation for the reversal. Now, they also looked at how momentum interacts with other company characteristics like size or the ratio of a company's book value to its market value. What did they find when they did those more complex sorts?
Yeah, they created these more detailed portfolios, for instance, looking at momentum within different size categories of companies or within different book to market categories.
Double sorts.
Right. They found that while the overall accuracy of their model sometimes dipped a bit when examining these more complex scenarios, the mean absolute errors got a bit bigger, and sometimes the model was statistically rejected.
So it wasn't perfect.
No, not perfect, but it still captured some of the patterns. However, there was one particular area where the model really struggled, the relationship between momentum and the book to market ratio.
Ah, the value growth dimension. For those who might not be familiar, what's the significance of the book-to-market ratio again?
The book to market ratio is essentially a way to classify stocks as either value stocks, high book to market, meaning the market values them less relative to their accounting value, or growth stocks, low book to market.
And traditionally, these types of stocks have shown different return characteristics. And the way momentum interacts with this value growth dimension in the real world is quite complex, isn't it?
It is, and this study found that their model couldn't quite reproduce the negative relationship that's often observed in the data, where momentum profits tend to be lower for high book to market value stocks.
Yeah. So the model got that interaction wrong.
Yeah, basically. In their model, the opposite tended to happen. The momentum effect was often stronger for the higher book to market stocks, which contradicts what we usually see. So that's a clear limitation.
Okay, so the model isn't a perfect mirror of reality, especially on that interaction. But they also explored the connection between momentum and risk, particularly this idea of long-run risks. What did their analysis reveal there?
Right. This connects to work by people like Bansal and his co-authors. They used a statistical method to assess how sensitive a portfolio's cash flows were to long-term trends in overall consumer spending. That's a key measure of this long-run consumption risk.
How exposed are these companies to fundamental long-term economic shifts?
Exactly. And consistent with some other research in this area, they found that the stocks of price momentum winners showed a higher sensitivity, or beta, to these long-run risks compared to the losers. The evidence was a bit weaker for earnings momentum, though.
So winners are riskier in this long-run sense.
That's what the stock return data suggested. And what's really interesting is that when they defined a measure of a company's fundamental cash flow based on their own investment return model.
Using the model's outputs.
Yes. They also found that winners had higher long-run risks and faster growth in this fundamental cash flow measure. So it helps connect their investment-based story back to these broader theories about how fundamental risk and return are related in financial markets.
That's a nice link. They also investigated how stocks with strong momentum tend to move together in the market, right? This phenomenon known as co-movement. What insights did their model provide on this?
Yeah, the data indicate that stocks that have experienced extreme momentum, the very big winners and the very big losers, tend to move somewhat in the same direction. There's a shared component to their returns.
The momentum factor,
And
essentially.
kind of, their investment model was able to reproduce this tendency for positive movement among these momentum stocks.
So fundamentals drive some of that shared movement.
It seems so. But importantly, the strength of this movement in the model was less than what's actually observed in the stock market data.
So the model only explains part of the movement.
That's what it suggests. While fundamental factors related to investment clearly play a role in this synchronized movement, according to the model, there might be other factors at play as well, perhaps related back to investor sentiment or market psychology, that contribute to that extra movement we see in actual returns.
Okay, let's take a step back for a moment. We've covered a lot of ground. What's the main point, the big picture we should be taking away from all of this research?
I think the central takeaway is that this research offers a really compelling, fundamental economic-based explanation for why we see the momentum effect in stock markets.
It's not just psychology.
Right. It suggests that momentum isn't just some oddity of how investors behave, but that it can be deeply rooted in the rational investment decisions that companies themselves make, based on their expectations for future growth and profitability. It's pretty remarkable, actually, how a model built on these core economic principles, investment, adjustment costs, production, can explain so many different aspects of momentum.
Yeah, the fact that it exists in the first place, the average profit size,
That it eventually fades and reverses,
even some of the ways it interacts with other characteristics of companies, like size.
and linking it to these fundamental long-run risks in cash flows, it covers a lot.
It really does. But, and this is crucial, we have to remember that no model is perfect. This one didn't fully capture, say, how momentum varies in different market conditions or over the business cycle, which some behavioral theories might address.
And it definitely had some trouble with that specific relationship between momentum and the book-to-market ratio, as we discussed.
Exactly. Those are important caveats.
So here's something to really think about, a kind of provocative thought for you listening. While we often think of momentum as potentially being driven by irrational investor behavior, this research kind of flips the script, doesn't it?
It really does.
It suggests that the very actions that companies take seemingly rational decisions about where to invest their resources, driven by expected profits and growth, could be a significant underlying driver of this market phenomenon.
It doesn't necessarily mean the market is always perfectly rational or that behavioral biases play no role.
No, but it certainly adds a fascinating and maybe unexpected layer to our understanding how market dynamics work. It's the firms themselves contributing to momentum.
And this research really opens up some interesting avenues for future work, too. The authors themselves propose exploring the role of industry-specific factors in their model, which seems like a natural next step.
Yeah, does this work differently in tech versus utilities, for example?
Right. And also extending it to see if these fundamental investment drivers can help explain momentum in international stock markets or even in other types of assets like currencies or commodities where momentum effects have also been observed.
That would be fascinating. It makes you wonder how these fundamental investment decisions might play out in different economic climates, different regulatory environments, across different kinds of assets.
Definitely fertile ground for more research.
So we really encourage you to ponder this perspective. How might it shift your thinking about why we see these persistent patterns in the market? It's not just about traders, it's about the companies.
And if you have any thoughts or questions that this deep dive has sparked, please do share them with us. It's all part of this ongoing journey of trying to understand the intricate and often surprising workings of the financial world.